So some experts out there will say you need 5 million to start your own fund, or 20 million, or some people say 50 or even 100 million to start your first fund. I always kind of smile and laugh because it's just exactly opposite of what I did. You had to have a $4 billion net worth and a $100 million minimum commitment. We've now helped hundreds of people launch these funds. It doesn't matter if you're old, it doesn't matter if you're young. The example is to just get started. The first time I actually raised real money. So in college, those first 6 businesses were all bootstrapped. I did them all by myself. It was me putting a little bit of capital in. It was mostly just sweat equity and time to build out whatever we were building. The first time though I ever actually went and tried to raise money was for actually my first syndication/fund that I launched. So I was in college, I was working at a company. This company, they had this idea that we could fund people in their company that needed financing. So these people needed loans, they needed short-term loans, and they were $2,000 to maybe $5,000 per person. These loans would last about 2 to 3 months, and then the person would get this capital from this new thing they were doing and pay us back. And so we talked about this, and I was somewhat inventive as a student. So I was on the whiteboard, we were putting this all out. My family was in the game of funds and financing, so my dad and brother, and I said, hey, I think we could do this. I think we could build some kind of vehicle around going out and financing these clients that were coming through this business. The owners of the company, they liked this idea. I took it to my dad and brother. We kind of formulated what this would look like, this kind of micro syndication fund. It was a debt fund or private lending fund that we would put together. And so we put together all these documents. My dad, there's a whole story behind there, but my dad made me read through all these legal documents, LPAs, PPMs. It took me like 3 or 4 weeks to just sort through. I was on Google trying to figure out how to legally structure this thing together. And we finally came up with a pretty good solution of how to launch this product. And so I was excited. We were going to launch this new investing product. And I was like, okay, I had the structure set up. My brother helped me with the legal docs, putting it together. And I said, okay, I think I'm ready. Crap. Now I got to go raise money. And I've never raised money before in a venture. And so I thought, who should I go to? Who will invest in this thing? And I was like, well, duh, my dad. I'm just going to pitch my dad first. Case 0, I'm going to go pitch my dad. So I remember I set a little meeting up with my dad. I went to his home office in his nice little studio he had at his house. And I said, Dad, how would you like to be our first investor into our fund? And my dad kind of smiled and laughed. And he said, Bridger, I have the money to invest in your fund. But if I invest in your fund, it would ruin the experience of you raising money on your own. If I invest in your fund, this will be a crutch that you'll never be able to recover from. And he said, no. And he kind of kicked me out on my own and said, you got to go figure this out on your own. And so I walked out with my tail between my legs a little bit, got my first no. My dad's an incredible mentor, helped me walk through this fund, putting it together. And it felt like a little bit of a bait and switch because I went and pitched him for money. And I don't know why. My dad is so conservative. He never spends money on anything. But for whatever reason, I thought he would have invested in my fund because he has plenty of money. And he doesn't spend it on cars or houses. He spends it, he likes to invest a lot. And I thought, this is a great investment. He loves it. He's telling me how much he likes the idea. He would love this investment. And then he says no. And I was like, huh. But I immediately understood what he was doing. It actually made sense to me. I didn't feel mad. I wasn't resentful at all. I was like, no, this guy has helped me beyond what I ever expected. I was so grateful for his help. And I was like, oh yeah, that's actually a good point. If he invests right now, people will just say, oh, it's your dad helped you or daddy's money or whatever the comments are. And actually till this day, my dad has still never invested in any of my funds. I run now, we have 2 new funds that we've launched. My dad has still never invested. That same mentality of, I'm going to teach you how to fish. I'm not going to give you a fish. Yeah, my dad's a phenomenal human being. He grew up in North Las Vegas, a relatively low income household. He went to Rancho High School, if you know Las Vegas. It is a tough high school he went to. He was one of his only friends that went to college. He went to Dixie State University. He started a bunch of companies. He was doing landscaping sprinklers. He started another business. He just grinded his way out of the hood, in his words. And we ended up getting raised in Utah in a way better place than he grew up in. And I think his mentality always was, I haven't made it yet. Things, I can always get sued. There's other things that can happen. I need to make sure everything in his life every car is paid off, every house, everything is fully paid off. He doesn't want to owe anybody anything because he knows, I believe, again, this is his psyche. I'm telling you what I think, but that where he's gotten to, he's at a good place. He doesn't want to ruin it. There's too many people that that we will see over our lifetimes that live at large, and then all of a sudden they blow up and they collapse. And for a long time, I remember actually asking my dad this, like, man, you see these people that they have the newest cars, biggest house, and then all of a sudden they blow up and then they cycle. They have these big cycles. These people that make it all and then they lose it all, and they make it all and lose it all. And my dad never really did that. I mean, kind of had everyone does have ups and downs, but nothing like that. And he just said, Bridger, it's just because people have egos and they live above their means. And he goes, when I make tons of money, nothing in my life changes. And when I lose lots of money, nothing in my life changes. Because I live kind of in the middle of that balance. And I was like, that seems like a healthy way to live life. And so my dad I've tried to adopt some of those principles for my own household with me and my wife and my son now of, and to live a course of a lifetime if you can just not blow up. So I asked my dad, I'm like, where do I go? And he's like, go to anybody. He said, you'll be surprised about who has money. There are people out there that, they have Lamborghinis and they have the big house and they're wealthy, but there are also people, he goes, like me, that live in a pretty normal house. They drive a normal car and they have millions of dollars stashed away. And so he goes, I wouldn't count people out. And so he goes, I would just start making a list of anybody that would be potentially in that universe. And he goes, worst case scenario, you get to practice pitching somebody, which is always good practice. Just get more hours in the game. Like Malcolm Gladwell, get 10,000 hours. Just start getting hours in front of somebody, pitching, presenting, selling. Doesn't matter who it is. And so we just put a list together. Like, okay, this guy that I knew from 5 years ago, this former boss, this person that I worked with on a thing a couple years ago, this guy I did a job shadow with, like, let's just see. And that's kind of the confidence I think you have to go out and just sell and just make stuff happen. But I took him up on the offer. I said, you know what, I'm gonna go figure this out. And I went the next 3 to 4 weeks, I talked to everybody I knew. I mean, it was former bosses, college professors, a neighbor, like anybody I could talk to. And essentially the pitch was this. I said, hey, we got this great lending product. There's some historical statistics on why this should work. We believe if we have less than a 5.5% default rate, we're gonna be well in the positive with our returns. I just walked them through a deal. This is how the deals are broken down. And then I would stop mid-pitch. And I would look at him right in the eye and say, I know you think I'm too young to be pitching you this today. Like, I know you're sitting there thinking, like, Bridger is this young college kid. He's never done this before. He doesn't have gray hairs. Like, this will never work. And like 9 times out of 10, they'd kind of like nod their head like, yeah, I'm thinking that right now. And I go, well, let me explain to you why that works to my advantage. I said, generally, when someone's trying to pitch you a fund, you want them to have gray hair, 50 years of experience. They live in a big house. They drive a nice car. They've done this for years, right? And they're like, yes, correct. I said, well, that's great. That's one option. But that person that's running that big fund, they're going to charge you a lot of fees. They're going to charge you a lot of times a 2% management fee or a 3% management fee. For my fund, I'm going to charge you a 0% management fee. I'm going to put my money where my mouth is. Number 2, that person who's old and wealthy and wise, they're not in the grind every single day. They want to hire a team. They want to delegate. They've got their nice lifestyle. They go to Hawaii 3 times a year. They're on the coast of, Cape Cod, and their yacht, whatever their thing is doing. They're not on the grind. Because I'm young, I'm in the day-to-day. I'm here every day. Like, this is what I'm doing. And I have no propensity to commit fraud. Meaning the people that are already wealthy, they've got to keep up a lifestyle. They've got to maintain this big wealthy lifestyle. They might steal money from you and commit fraud. Me? I'm like, I live on $300 a month. I have no reason to commit fraud. I'm not even going to charge a management fee. I only make money when you make money. That's how confident I am in this product. For whatever reason, I think maybe they were just like this young kid or dumb luck, whatever, but a lot of people said yes. And they said, you know what, I'll throw some, and all I said was this: I don't need a big investment. All I need is a trial investment from you. I am going to knock your socks off. My goal of this fund is not for me to get independently wealthy. My goal is that you will have such a great experience investing with Bridger that you will tell your friends and your other friends about how great this was, how great of an experience, how much money you got back. And in the future, over the next 5, 10, 30 years, you'll keep coming back and investing with me more and more. That's my goal of doing this. And so anyways, that was my pitch. For about 3.5, 4 weeks, I raised a whopping $49,500 from roughly 6 or 7 investors. Teeny fund. It was like teeny, but it was enough to get started. We launched this teeny little micro fund. We started doing these loans, and these loans again were $2,000 to $5,000 a loan. They took about 2 months to come back, and we started flipping these loans. And we ran that syndicate for about 7 months. That first group of investors got a 64% return on their money. So phenomenal amount of return on their money, small amount of money, but good return. And then we kind of transitioned that into our first full out Reg D fund. That fund, I launched, and we raised roughly in our first raise about $850,000 for the next 6 to 12 months. And I was 22 to 23 years old at that time. So I'm managing just under $1 million. We are rolling about $3 to $5 million of loans per year. I hired a bunch of interns at my university. They were doing these loans. They were on the phones. They were calling people. Again, these are small loans, $3,000, $5,000, $10,000 loans. We were doing debt consolidation and rolling these loans. I believe our next year's returns, cash on cash, 62% return, 47% the next year, and 36% cash on cash return to investors. We then had actually a competitor that we were kicking out of the space came and gave us an offer, and we actually sold that fund to our competitor. We paid back all of our investors, all their principal plus their return. It was a phenomenal exit, and did all that out of college. What is a Reg D fund? How are they put together? What are the nuances of Reg D filing? So under the SEC, the Securities and Exchange Commission universe, they have created some interesting products that people like us can use for private funds. One of the most common ones for private money raised is under Regulation D, Rule 506. So Reg D 506, 99% of the private money in the world is raised through that little filing, Reg D 506. And there's two subsets, 506B and 506C. And again, so Reg D 506B and 506C, those are, 99.9% of the world's private money goes through those. All of Ray Dalio's and Jim Simons and Ken Griffin's, all these huge fund managers, all of their funds are pretty much filed under those two filings. Why? Because they allow you to raise unlimited amounts of money in a private offering. Now, a few nuances of those. In a Reg D 506B, one of the nuances is you cannot publicly advertise under a B. That's why you don't see Blackstone or KKR or Sequoia running ads. They don't run billboards. It's actually against the law for them to run those types of advertisements. In there as well, they have to raise from certain investor classes or investor pools. And those different investor classes are, number one, non-accredited investors. Number two, accredited investors. Number three, qualified clients. Number four, qualified purchasers. These are the 4 different types of investors that's been deemed by the SEC. So a quick run through of each one of them. So non-accredited investors, they don't fit into any category. So that's just anybody else if you don't qualify, okay? Accredited investor, under current rules, you have a $1.1 million net worth, excluding your primary residence, or you make $200,000 a year or $300,000 a year with a spouse. Additionally, they've added some new rules recently that you can take a test. If you're a FINRA licensed investment advisor, you can qualify. There's a few other things you can do, but that's the general rule for an accredited investor. You're essentially a millionaire besides your home. The next tier above that is qualified client. A qualified client has a $2.2 million net worth, excluding their home. And then above that, a qualified purchaser has a $5 million net worth, excluding their home, or an entity with $25 million in assets. Now, these are important because under a Reg D 506B or 506C, they will determine what type of investors you can raise from. Most big funds are raising from at least accredited investors or above, and most are raising from qualified clients or above. So if you want to invest in Blackstone's funds, you have to at least have a $5 million net worth. And a lot of times, we can talk about it in a minute, but they limit you to total number investor pools and how those are put together. So again, under Regulation D, 506B and 506C, again, 506B, you cannot publicly advertise. 506C, you can publicly advertise. So my current fund, Ugly Unicorn, we're actually at 506C, so we can advertise. But because of that, every investor in our fund has to be accredited, and we actually have to verify that they are accredited. So we have to have maybe a CPA, a lawyer, tax documents that confirm this person is an accredited investor. Now, beneath there, most funds, I'll tell you kind of the general rules for most funds. They select one of 3 exemptions beneath a Reg D 506B or 506C. Those exemptions are 3C1, 3C5, or 3C7. And I'll quickly go through those and I'll give you an example. So number one, 3C1, so a Reg D 506C 3C1 fund, if that's a mouthful, that's what our fund is. So our fund, we can raise from accredited investors, and we are capped at 99 investor spots. So literally by law, I can only have 99 investors if I'm a Reg D 506C 3C1 fund. The middle one is a 3C5 fund. This is for real estate funds. They have to have over 80% of their holdings in real estate, and they can raise from 1,999 investors. So essentially 2,000 investors they can raise there. And then the final one is a 3C7 fund. And they can raise from, again, 1,999 investors, and every investor has to be a qualified purchaser. So now this is a big deal when you're limiting investor sizes. So for example, Ray Dalio with Bridgewater, one of the most successful funds of all time. I believe they stopped raising capital in 2005. It's the last time they raised money. We say, like, why? And they manage right now about $150 billion. Well, it's because Bridgewater's funds are a Reg D 506B 3C7 fund. Ray Dalio was capped to essentially 2,000 investor spots. And so to invest in those funds back in 2005, you had to have a $4 billion net worth and a $100 million minimum commitment to invest in the original Bridgewater funds. And you're like, why? Well, it's because he's only got 1,999 spots. And so Ray has to fill up each spot with the most amount of money. And then after they filled those spots, they've actually closed those funds. You can't even invest with Ray Dalio for the last 15, 20 years because it's closed, because they filled those investor spots. The same thing's true with Jim Simons or Ken Griffin. These big fund managers, you can't even invest with them because they have filled under a 3C7 fund, they've already filled their 1,999 spots. And so this is why most private investment funds or private hedge funds or venture capital real estate funds are exclusive to the ultra wealthy. It's because of actually the SEC's rules on how many investors you can have on your fund. And as a fund manager, you're going to try to get the most out of each investor spot. What licenses do you need to start a fund? Now, every fund is actually a little bit different. So depending on what fund type you are, whether you're running maybe a debt fund, a private equity fund, a hedge fund, a venture capital fund, and kind of how I classify it is from, I guess, least regulated to most regulated. Venture capital, for example, is very unregulated. They must have really good lobbyists or something, but if you run a venture capital fund, the amount of licenses you need go way down. Next up on that tier is real estate funds. Real estate funds as well usually have a lot less scrutiny on their licenses. In the middle is private equity funds. Beneath that, you go to debt and hedge funds. And hedge funds would be the most regulated, debt would be a little bit less, and private equity kind of in the middle. So depending on what type of fund you're running, the regulations change. So back to the question of, did I need a license for my first fund? This also determines in the United States on how large your fund is. So there's a threshold at $150 million of assets under management. If you are over $150 million of assets under management, you fall under the SEC's level, Securities and Exchange Commission. When you are under $150 million, you fall under the state level. And every state has different nuances for what they are doing. So if you live in Utah or California or New Hampshire or North Dakota, you're going to have different rules on what licenses you need. Now, most people listening to this, depending on where you are, this will be determined on how you're put in. And the buckets are, if you're over $150 million, you generally have to file as a registered investment advisor or RIA. If you're under $150 million, you would file as an investment advisor or IA under the state level. You don't file in both. It's either or. You're either at the state level or you're at the federal level, not both. And so for most funds, my fund was under the $150 million threshold. So I was in the state level. We looked at Utah state laws. I hired a lawyer and they told me, Bridger, you do not need to have a license to run this fund because a few things. You're not running a management fee. Because you're not charging fees for investment advice, you're not giving investment advice, you don't need to be filed and registered as an investment advisor. Now, if I was charging management fees or giving investment advice, I maybe would have in the state of Utah had to get a license. Additionally, in most states, you can file as an exempt reporting advisor. This allows you to be exempt from some of those licenses that you would need to become truly an investment advisor. Now, when I say investment advisor, that's the same as, when your brother-in-law that's like, hey, I work at Merrill Lynch and I'm trying to get your money and manage, be a personal wealth manager. That's the same licenses. It's the Series 65 is the most general license. So the Series 65 is what your brother-in-law would take as an investment advisor at Merrill Lynch and is trying to get you to manage your money. It's the same license. And when you're running a fund, you are also giving investment advice. However, you're not giving investment advice to your cousins and your neighbors. You're giving investment advice to your fund. And your fund is paying you a fee for that investment advice. It's the difference between retail investment advice and wholesale investment advice. And when you're running a fund, you're giving wholesale investment advice. If I'm giving it to my cousins and in-laws, that's retail investment advice. Under the FINRA rules, if you're giving a fund wholesale investment advice, a lot of times you can file as an exempt reporting advisor, where they exempt you from holding some of those licenses because you're only giving investment advice to your privately held fund that has accredited investors that's filed under maybe a Reg D 506C fund. Now, continuing the conversation of licenses, what other licenses would I need? So back to each fund type, it depends. So if you're running a venture capital fund, it's relatively minimal or zero. If you're running a real estate fund, you might want a real estate license or commercial broker license, or maybe someone on your team holds those things. But when you look through all these funds, and we've now helped hundreds of people launch these funds, most people don't need any of the other licenses, which is kind of cool. So even, for example, if you're running a hedge fund and you're trading futures and commodities and all the other things, you can have a license if you want. You can go get a Series 7 or a Series 33 or a Series 23, whatever license you feel like you need. You can do that if you want to trade directly. Most hedge funds, though, that are small startup use prime brokers or outside firms. It's the same thing that's true with private equity or hedge funds. They use outside brokers, whether it's a prime broker or a broker dealer, to help issue and transact the trades that they are using. So if I'm running a hedge fund, I'm giving investment advice to my fund. I may need a Series 65, or maybe I can file as an exempt reporting advisor. I wouldn't need any licenses. To execute my trades, I will use a prime broker that will put leverage or things on my fund, and they will execute the trades for me, and they hold the licenses to hold and execute those trades. Now, when you get bigger, some of the bigger funds you'll see out there, they bring their prime brokerage in-house. They bring their whole brokerage in-house. That's why you'll see firms that every person that works there has to have a Series 7, a Series 66, a Series 65, all these licenses, because they've brought it in-house. And that makes total sense. But when you're starting your very first fund, that's a lot of headache that you don't have to deal with in the beginning. Now, again, always counsel legal advice. Don't take this as legal advice. Go talk. In every state is a little bit different. Every industry and product is different. But as a general rule, a lot of funds you can run with a Series 65 as an investment advisor or registered investment advisor, or you can file and become an exempt reporting advisor and have no licenses if you're under that $150 million threshold, and you use outside prime brokers or brokers to execute your trades or deals. Yeah, so that first chunk of $49,500, I invested a significant amount of my money into that. So I put in, I can't remember the exact number, it was in the thousands of dollars that I put in of my own money, because I wanted my money parked right alongside my investors' money as well. Why did I invest my money alongside my investors? Number one, I think that's a good practice. I was told by people like my dad and brother, every time you launch a fund or raise money, you should have your own money right alongside your investors. I believe it's almost unethical to make investors invest into something that you're not willing to put your own skin into as well. It doesn't need to be whatever a large amount to you is. In my opinion, it should be a significant amount of your personal net worth should go into this thing. If you have enough confidence to go pitch other people, you should be putting a significant amount of your net worth into that thing. Now, on my first fund, $5,000 was a very significant amount of my net worth, right, into that fund. Now today in my Ugly Unicorn fund, I have just under $1 million of my own money in my fund right now, right alongside my investors. Why? Because I believe in the product so much that I want to put my own money in right alongside them. And it gives them confidence as well that Bridger believes in this thing. And hey, I'm right there with you. The market might go up, it might go down. I'm right there with you. My money is alongside you. So some experts out there will say you need 5 million to start your own fund, or 20 million, or some people say 50 or even 100 million to start your first fund. And personally, I read these blogs or these articles that people write, and I always kind of smile and laugh because it's just exactly opposite of what I did. Now, I know people that write those are well-intended. They walk through all the expenses and things and calculations of why you would need that amount of capital, and it totally makes sense. But most people that write those articles have never actually launched a fund. They are a blog writer that got an assignment from their boss to write something about managing funds. They've never actually been in the game or space doing this. There are a lot of things that when you're a small fund, you can do at minimal levels. And as you scale, yes, those expenses grow, but you don't need to expense them as deeply when you're beginning. So some people will say you need 20 million in assets under management to even consider launching a fund. And the way they do that calculation is say, well, 20 million, a 2% management fee, that means 400,000 a year is coming in, and you can use that 400,000 a year to pay for compliance and your asset management team and salaries and other stuff like that, which makes sense. So what they say is, you got to pay $50,000 for your audit, $20,000 for your taxes, $70,000 for your insurance, and they go down the list, which is, again, well-intended, but not always actually the truth. We have found with small funds, first-time funds, you can actually condense a lot of those payments because it doesn't cost $60,000 to do an audit. It costs maybe $10,000 to do an audit or $15,000 to an audit. You don't need $100,000 on a compliance handbook and manual at that level. Yes, if you ran $1 billion fund, for sure spend $100,000. But at a small level, you might only need to spend $2,000 or $3,000. And so there's a lot of benefit, and I believe, in just getting started and just moving. We have people in our group starting funds that are $400,000 funds, $800,000, $1 million, $2 million, $5 million funds. Again, they're going to grow into those bigger things down the road. But at the time when they're starting with a small syndication or small fund, what it allows them to do is get in the game and start moving. A few examples. Most people think I've got to work on Wall Street for 20 years before I get in this game, which is a fine notion. I think that's a one route to do this game. I need 20 years. I need $100 million to even start. And then one day, maybe I can be Warren Buffett or something. What's funny though, is I went actually back and studied people like Ray Dalio, Warren Buffett, Leon Black. You look at the careers of these people. Funny enough is almost none of them did that route. Warren Buffett started his first fund at 26 years old, raised $105,000. What happened was he invested into a windmill company, did this. He actually did extremely well. And then it dovetailed and he compounded over. And now Warren Buffett's in his late 90s, almost 100 years old. He's compounded for 70 years. When you can compound for that long, you tend to do extremely well. Ray Dalio was, I believe, 25 or 26 years when he started Bridgewater Associates out of Harvard. And he just started moving and compounding over now 30 to 40 years. And ta-da, Ray Dalio's worth $28 billion. From there, Ken Griffin, one of the most successful fund managers of all time. Again, people think I got to work for 20 years. Ken Griffin didn't do that. Ray Dalio didn't do it. Warren Buffett didn't do it. Ken Griffin started trading when he was 19 years old. At 20 years old, he launched his first little micro hedge fund. He compounded, did well. By the time he was 30, again, he was 30. That sounds young to some people. He'd already spent 10 years running a fund, though. He was managing over $1 billion by the time he was 30. Why? Because he started when he was 20. He compounded. Today, now he's one of the most successful fund managers of all time, runs Citadel. When you start studying these fund managers, a lot of them didn't do the traditional route that most of us think. And they will get on stage and they will say, yeah, if you want to be like me, go work for 20 years and work your way up the career, and eventually you can run your own fund. But I listen to what they're saying and then I watch what they're doing. All these titans of finance didn't do any of that. They started, and they usually started very small and just started compounding after that. Now, not to say that's the only route. There's other examples. Kathy Wood is another example of someone who worked her way up her career at 50-something years old, started her first fund, and now runs ARC. They manage tens of billions of dollars now. There's other people that have done different routes. But what I'm saying is there's not just this one sustainable route. And a lot of these beliefs that people have, I got to work on Wall Street for 30 years. I've got to go to this university. I've got to start with $50 million. Time and time again, you look at the examples of successful people today and they keep getting broken and shattered. And so I actually love those examples because it doesn't matter if you're old. It doesn't matter if you're young. The example is to just get started. Another example is Grant Cardone. Love him or hate him, he's a volatile character online. He runs Cardone Capital. I think they manage about $4.5 billion right now. Grant Cardone did not start his first fund until he was over 50 years old. He was a sales trainer. He just did sales coaching for years, and he did okay buying real estate and stuff by himself. He was, I think, 53 years old, started his first fund, and now he's 66, 67, 68 years old, something like that, and now manages $4.5 billion and has a jet and all these cool things because he got in the game and just got it started. There is so much validity in just getting moving. You talk to any fund manager and they'll tell you the first million is the hardest million to raise, or the first 100 million was the hardest 100 million to raise. Once you've raised that first chunk, the next chunk is a little bit easier, and the next chunk's a little bit easier. For me right now, I manage a $25 million hedge fund. Raising our first $1 million was extremely hard, but the second million was a little bit easier. Raising the first 10 million was extremely hard, but the second 10 million was a little bit easier. I believe that will continue to happen. I'm at 25 million right now. Hopefully we redo this video in a couple of years and we're much larger than that. And I'll say, oh man, the first 25 million was way hard, but the next 25 million was a lot easier. And I think there's a lot of validity in just getting started on the path because it gives you years to compound as you go forward.